Congratulations on finishing lesson 1 and welcome to lesson 2. In the previous lesson, we gave you an overview of what a stock actually is. If you can define stock at this point, then great job. If it's still alien to you, please make sure to go back through lesson 1 a couple of times. They're really short videos, and if you have any questions, just let us know. In lesson 1, we mentioned stocks, otherwise known as equities or shares, are traded on the stock market. But what actually is a stock market? And what's its function? The stock market, by definition, is a place where people come together to exchange one item for another. In this case, it would be credit or cash for stocks and shares. I like to think back though to the old times where the farmers' markets before our time took place. Live auctions were happening where one person would exchange things like wheat or grain for cattle. The principle is exactly the same, this time with a bit of a modern twist. In a modern context, we have companies from all over the world offering their stocks and shares to the general public. This is done electronically these days. It's facilitated by using the means of a stock exchange, where the buyers and sellers come together at the stock exchange to trade one security or asset for another. If I want to buy 100 shares of Facebook, the transaction would need to take place on the stock exchange. The exchange itself makes sure that the buyers and sellers are connected in a more regulated environment. It actually acts as a mediator of sorts to ensure that transactions are smooth and legitimate. As we are more connected than ever, you can now buy and sell stocks from all other countries over the world, own multiple currencies and assets, all with the click of a button, thanks to the internet. It's made the stock market very accessible for many participants. A participant being the likes of myself and yourself, retail investors, hedge funds, banks, other companies, and even large governments. In order to access or buy the shares on the market, you actually need to use a stockbroker. A stockbroker will allow you to buy and own the shares of your preferred company and facilitate the exchange. What this means is that when you sell your shares, the broker will actually help you find a market for it and make sure that your shares are sold. In order to sell your shares, you need to find a willing buyer. The stock market broker will take your order to the exchange digitally, and if someone wants to buy your shares, they facilitate the exchange. A broker may charge a fee for this exchange. In our next lesson, we'll make sure to cover what stockbrokers actually are. For now, it's just important to focus on the fundamentals. We have our stock, we want to sell it, and now we need a place for that to happen. That happens in the stock exchange. Sometimes it's tricky to think of this concept because it's mostly done by computers and global networks of computers that are in constant communication. I always try and peel it back and think of it in real terms. So if you want to go to a shop, for example, you'll see hundreds of services and goods displayed on the shelves. These are all by different companies. You can buy Oreos from one company and candles from another company. All these companies are under the same roof of one large shop. This would be likened to a massive market, or the stock market. But when you take your basket to checkout, you actually have to pay for the goods. This is done by the checkout, which I would liken to a stockbroker. It's just that simple. Sometimes, though, the financial jargon makes it sound extremely confusing. Don't worry, when I started investing, I had no idea of what any of this meant. I hope this makes sense. If not, please stop the course and ask us any questions you may have. Let's move on to selling the shares. Seeing as we know how to buy them, how do we actually sell them back? In order to sell your shares, you need to have a willing buyer, or otherwise known, someone bidding on the shares. If nobody bids on your shares, you may have to lower the price to sell them. It's really back to our supply and demand economics. If your shares are in high demand, there's a strong likelihood someone's going to offer you more money for them. Likewise, if they're in low demand, there's probably a good possibility that you'll have to drop the price to sell them. Remember, the buyers can be banks, me and you, or any of the participants mentioned earlier. So where are the stock markets actually based? Pretty much most countries have their own stock market. A few examples of stock markets would be like the American Dow Jones, the Australian ASX, the German DAX exchange. In your own country, you probably have your own exchange. A simple Google will probably find out if you have it or not. Basically, if you live in the South Pole, you can technically buy shares in Mexico, India, and the USA. The possibilities in our information age are really endless. In our next lesson, we'll actually go over what a stockbroker is, how to select a good one, and how to avoid really bad ones.